All right. Hey, everyone. Yep, it's me. Special Investment Tuesday, Halloween special. I came dressed. I'm going to do the whole Investment Tuesday with my Halloween mask on. I hope you like it. If you enjoyed. All right. I was just kidding. I can barely breathe and I can barely see. And we've got an incredible Investment Tuesday for you today. Let me take this off. Um, We're going to talk about something that is happening that is getting so little attention. And my 30 years of experience managing multi-billion dollar hedge funds, managing money for billionaires. Yeah, these are the kinds of situations that we would be like, look at the facts, look at the evidence. The world is like not focused on it because we got AI mania, tech obsession going on. People are not looking at what is going on. And I think this is going to be big. I think it's going to be big. And I'm going to lay it out for you and tell you what we have done in ATG Digital Portfolios. So let's get going. All right. And happy Halloween, everybody. Happy Halloween. Let's do very quickly all the legal disclaimers and disclosures, which says this video and the content from ATG Digital is not investment or financial advice. It's presented to you as my opinion, my view, my take, my view of the world. You use it as information, engagement, entertainment, whatever you choose to do with it. It is your responsibility because it is your money. Next, all ATG Digital content may contain errors, oversights, and mistakes. Understand that investment operations have significant risk. What's an investment operation? Buying or selling the stock, crypto, option. They have significant risk and can lead to loss of your principal. Loss of your principal means losing money. Next, I, the owner, as employees, contracts of ATG Digital, we own, we trade, we transact in the securities that are mentioned in this video and all content from ATG Digital. We do not take money from companies or crypto promoters, sponsors to recommend their stocks or crypto tokens. We publish an extraordinary amount of free research, which you can check us out. And in fact, the subject of this Investment Tuesday will also be the subject of my Substack that was published yesterday on Monday. That's my regular day. I really recommend you subscribe to Substack. We got individual ideas. We got macro. We've also got general guidance on, everything about investing that generally most people just don't cover because they lack the experience. Social media, we are on X, we are on Instagram, we are on Facebook. How can you get more of what we provide? Well, one of the things that you can do is you can choose to join this YouTube channel where we have a members only section, which gets you early access to Investment Tuesday. And also about once a month, you get a special bonus video that is for members only. The other place where you can get access to pretty much all of our paid content is atgdigital.media. Very important in today's world that you make sure that you are on the right website. Just don't go by shortcuts like, well, that's the right color, that's his picture. No, atgdigital.media is the correct place. Let me put that up, atgdigital.media. We have subscription plans that start at $9.99. So check us out over there. All right. With that done, let's get to the business at hand. And I'll cut to the chase because there's no way to really tease this, even though people I think they enjoy it. And I'll shut down some tabs here because we got a lot of tabs to go through. And whoa, those firecrackers or some guns going off in the background. It just caught me by surprise. But this is going to catch people by surprise. What is this? Let me make this a little bit bigger. Okay, that's about as big as it's going to get. Okay, let us go through this. This is a chart of West Texas crude oil, which is the most commonly referred to oil price. Now, there are, West Texas crude is a grade of crude. We're not going to get into all of that other than to say that there are many, many different grades of crude oil. This is one of the most commonly cited, and generally when people are talking, it's like the oil price went up, they're talking about this, right? If you're in Europe, you'll be talking about something called Brent, and then, there's, like I said, many, many others. Okay, what is this chart and what is the relevance to what we're going to cover in this Investment Tuesday? This chart essentially is what about 18. This starts at 1983 here and goes to the current time, which is 2025, right? So 42 years. What it's missing to the left, which the chart provider doesn't provide, is the big oil spike that we had in 1970, which is when OPEC refused to sell oil and the price of oil shot higher. But every other event is captured in this chart, and you've got the events in yellow. What's the first one here in yellow here? That's the Gulf War #1. And those of you who are too young to remember when Iraq invaded Kuwait, the United States formed a coalition attack. Well, in the immediate aftermath of that invasion of Kuwait, oil prices spiked to what now seems like a very low number of $40. But that was in an era when the average price most of the time was in 20s. I mean, okay. For the most part, oil goes through the 1990s really essentially in a bear market. There's just too much supply. OPEC can't corral, all its members. What's OPEC? They're the cartel that more or less controls the supply of oil. It's dominated by Saudi Arabia and a bunch of other countries. Okay. Then we get, a mini spike here, which I didn't really put as an event. What is that? Well, that's the cyclical peak in the US economy driven by technology, the first coming of the internet. Then, of course, we've got the recession that comes after. And then we have, what is the first globalized sort of like economy where China becomes an enormous buyer of oil and other commodities. And the oil business is not prepared for that because, from 1986 to about 2000 or so, 14 years, there's no real demand for oil. And suddenly demand for oil starts to pick up. China creates its own petroleum reserve. Other countries start to increase their capacity, increase their consumption, and the oil industry is not prepared. So what happens when demand outshines supply? Well, prices go up. That's the nature of markets, right? I mean, so of course, that leads right into, of course, the 2008 global financial crisis. Demand collapses, and then we get a low price of like $41 or so. And then in the recovery that comes after, driven by huge interest rate cuts by the Federal Reserve, the European Central Bank. Now, what becomes important, which is the Chinese Central Bank, Japan, of course. You've got like a synchronized recovery where oil jumps from $40 to $114 or so. Then we go through these sort of like, after that surge that, off the bottom from the post 2008 global financial crisis bottom, oil sort of like hangs around. And then as the Federal Reserve and other central banks look to increase interest rates, people worry that demand is going to collapse. And of course, the price collapse. The truth is that during that period, even though stock markets, now in hindsight, we're like, that was a great time. The truth is there was no economic growth, right? I mean, everything was really the central bank juicing the economy with very low interest rates, pushing asset markets higher to keep, whatever that was going in place, right? I'm going to fast forward this, right? Okay, then we have, I want to point this out. I mean, which is this, bottom of $18 here, which is the post-COVID crash. Now, this was extraordinary, and I believe it's what's setting up this current market. In other words, every bull market is driven by some event where excess supply has just been taken in. Why? Because it got to such a low price that made no sense, had no economic rationale, was driven by extreme fear where people did illogical things that made no sense. And the people who understand a particular industry market, they were like, yeah, okay, you want to do that? That's fine. We're going to take it in. So what happened in the post-COVID crash? Well, if you remember, maybe you don't remember, oil prices went negative. Negative. That's correct. They would pay you to take a barrel. Why? Well, it has to do with the way the futures market is set up, which is that if you are betting on oil, um, it is a market for delivery. In other words, while many and maybe most people who buy and sell futures are doing it just for the price differences, if you can't actually, settle for price, then you got to take delivery. And as it turns out that, so many people were betting against oil in the COVID crash that there was nobody that wanted to take delivery. And so, yeah, people were willing to give you oil if you, could find a place to store it. So, that was like, the beginnings of the bottom. And from there, we, of course, had the post-COVID recovery and oil going to, something like $60, $70. And then, of course, we had the Russia-Ukraine war, which is the second event in what I believe is what is going to be, an enormous bull market for oil and generally energy. But for this Investment Tuesday, we're going to focus on oil. All right. So in the Russia-Ukraine, in the immediate aftermath of the war, we see one thing, which is that the oil business is not really prepared for a shortage. All right. The war breaks out and it's unclear at that point in time, like, will all of Russia's oil suddenly go off market? If so, how will it get replaced? Well, it's now been like almost 3 years. So that was back in May. Yeah, it's been over 3 years. And it turns out in the aftermath of the war, while there were sanctions put on Russia, in various ways, everyone that was, in the Western world were like, well, we can't really have Russian oil go off the market. We can't really have Russian energy go off the market. Why? Well, yeah, because the price, might go here or even higher, right? So everyone has been like, oh yeah, Russia, bad guy, Putin, bad guy, we want him gone, etc. Except that everyone's still buying their energy and feeding the Russian machine, the Russian economy, which is, of course, how they fund the war. Doesn't make a lot of sense, but Europe continues to buy vast amounts of Russian energy because they made a really terrible, made terrible policy, which we'll get to at the very end quickly, which tells me that this bull market will be long-lived. In other words, it will last a while. It will look like what we had from 2002 to 2007, because it's based on terrible policy, which is like, hey, we don't want to use fossil fuels. And so it's not that, we don't want to use fossil fuels, meaning like their own, but it's fine if we import it. Crazy policy. That's what they've pursued. So they, of course, were stuck. They're like, well, we can have an economy, we can have a life, but for that, we need to keep buying from Russia. And other countries like India and others continue to buy. If you're a country that doesn't have their own energy resources, yeah, you're faced with very tough choices. If you're offered, oil at a 20% discount, 30% discount, you're going to take it. Why? Because, well, it's good for your country. It's good for your economy. So what's changed? What's changed here? All right. What's changed here is, of course, the viewpoint of the American government. President Trump was elected last year, and one of his goals was to end the Russia-Ukraine war. And he imagined that this was going to be pretty easy. There was the summit in Alaska, and there were, many different things that he tried, but no deal, right? No deal. So President Trump has decided to up the ante. He's a deal maker. And I think his pride's probably offended that, he couldn't bring Zelensky, who was the president of the Ukraine, and Putin together and put a deal together. And so he's up the ante, and he's pretty serious. Let's go through some of the things that, are going on. All right. I had a little bit of a computer freeze. So if you see some cuts in between. So what's changed here with respect to the oil market, the Russia-Ukraine crisis, war, and why does it matter to oil and oil prices today? Well, what has changed is that the current US government, as you know, President Trump was elected last year, and one of his goals was to end the Russia-Ukraine war. And from following the news, I imagine that that he figured that using his deal-making skills, that this would be, something that by now this would be done. Like, I mean, he imagined that it would be fairly, I don't want to say easy, but that this could be done. Nonetheless, despite that summit in Alaska, despite multiple attempts to solve this, it hasn't worked. And now President Trump has decided to up the ante, right? So he understands that the key to Russian capability to continue to wage war is all about oil, all about energy. So one of the things that many people don't know is that Europe continues to buy large amounts of energy because they, in what is a terribly poor policy mistake, decided that they would essentially completely be dependent on Russian energy for everything. And so after Russia declared war on Ukraine, they were stuck. They're like, well, yeah, we don't want to keep buying their oil, keep buying their natural gas, but if we want an economy, we want a society, we're going to have to keep doing that. So perversely, Europe continues to send vast amounts of money to Russia, which of course is being used to fight in Ukraine. Then there are countries like India that don't have a lot of their own energy resources, where Russia is like, hey, we will give you a 20-30% discount on barrels of oil and energy. I mean, if you're a country that doesn't have a lot of oil and somebody's going to give you 20-30% off, they'll take it. So what's changed, and what's changed right now to make me come out and make this Investment Tuesday? Well, what's changed is this, which is that I'm just going to make sure that we got the right tabs here. Tab management is a critical thing. So last week, the US, the EU, and the UK, as it said, they've imposed huge sanctions on these major oil companies from Russia. I mean, those three are the biggest three, and essentially reflect all of pretty much all oil production from Russia. So what this does is that anyone that in any way, shape, or form deals with these companies, they get targeted. And because the US dollar is still the primary currency that's used for most oil transactions, this is not a small thing. So this is a huge ramp up in terms of the economic and financial pressure on Russia. All right, let me shut that tab down and move on to the next one, which is that we can already see that the market is in a state where even this jump, which is somewhat incremental. I mean, it's a big difference in the sense they're making it very targeted right at the Russian energy giants, if you will. Yeah, I mean, it made oil prices move last week, like 6%, right? I mean, 6% may not seem like a lot to you, but I can tell you, in oil markets, 6%, that is a big deal. And it wasn't just a spike. I mean, for a day, it lasted through the week, which tells you that the traders, they were willing to hold those positions through the weekend. In other words, they didn't think it was a one-time thing, right? Okay. Next year, this is the other ramp up that is happening, which has been happening for the last 2 weeks or so. And I think it was last week's Investment Tuesday, I told you that the pressure they're also putting pressure militarily on Russia's oil assets. And you can see here, Ukraine strikes Russia's fourth largest refinery, disrupting 80,000 barrels. You'll see on the side here, key Russian refinery unit halted. So they are really going after the Russian oil production machinery. And this is happening at the same time where um, they have now scared enough of the Indian buyers in particular, which the biggest buyers of Russian energy. I mean, there's Europe, but that's mostly natural gas for the most part. But oil, it's China and it's India. Now, India and China aren't friends, and India, given a choice, would probably prefer not to piss off the United States. They've had a long-term relationship with Russia, but they also have, a sizable relationship, economic and financial relationship with India. So they don't really want to piss off the United States. And President Trump has kept this very high tariff level on India, which is 50%, which is like way more than the vast majority of countries in the world. And the purpose behind that is to create this. Reliance, for those who don't know, is one of the biggest companies in India. They dominate, they're a conglomerate that has everything. I mean, petrochemicals. For them to stop buying Russian imports, that is an enormous deal and will hurt Russia and will hurt Russia's ability to generate revenue. So, in other words, the sanctions, which were just announced like last week, are already beginning to bear fruit. So we've got all these things, in of which, like if you're looking at it, it's like, okay, Paul, this small little thing, what's the big deal? So, the other sign that all of this is starting to have some impact is that Russia is beginning to clearly feel it. And how do we know that? Well, Putin is having, his whoever runs, I don't know what MFA. I guess MFA stands for, Ministry of Foreign Affairs, right there. He's reminding the world, which is that you can try and take us offline, but just remember where the balance of supply and demand are. And he says clearly, and you can have this checked. It's approximately true, which is that the United States produces 13 million, but we consume 20 million. Then you got Saudi Arabia, which produces 10 million. Russia is about 10 million. And then you've got, of course, smaller amounts, but these are the big three. And he's like, if you yourself consume 20 million, where is everyone else going to get their barrels from? And what will the price be if you are successful? All right. So let's go back to this chart again. Right. Let's go back to this chart again, which is from 1983. And now look at the blue lines here. Right. So, in the 1990s, at the beginning of globalization, there's an enormous glut of oil caused by the 1970s oil shock. Remember, markets work like this. When prices go up, supply will come online. Everybody will find a way, whatever oil, if you can get it with a bucket, with a tin can, you'll go get it. So it creates this enormous long-term glut, which is great, which kind of caps oil at about $40, right? That's the first blue line here. Then for the most of the immediate post 2000 period, oil is at somewhere in the range of, let's say, 60 to 70 to $80, except for that big spike to 140. And that's continued to kind of hold as support, right? And then we had the mini spike, if you will, post the global financial crisis, because of Why would there be a spike? Well, when you shut down, everybody expects the world to go into a depression. And so you shut down production. So then, the world doesn't go into a depression. There's not quite enough oil, but it's not enough to sustain that price at a, at that level for a long time. And then, of course, we have the spike to about $110 in the immediate aftermath of the Russia-Ukraine war. Let's just say that President Trump says, well, you know what? There's going to be some pain, right? I mean, if we want to end this war, we want to teach Russia a lesson that it does not go and like invade its neighbors. It's not entitled to go back into, Ukraine or, who knows, like in the future, maybe, goes back into Eastern Europe or anything like that. It's worth it to take some pain. All right. In that scenario, almost certainly oil would go to $100, and we don't know. Like we might think that this might last, I don't know, 3 months, maybe 6 months. But maybe, China says, hey, you don't want to buy the oil? We need the oil. We'll take it. And they keep funding the war machine. Maybe it lasts longer. In that scenario, oil would go to 100, 110, 120. Maybe it goes back to 140. Maybe it goes even higher because we have gone through a period like, this period, like, we had that spike. But generally speaking, from some about 2016 to about now, most of the time, oil has been, under $60, which is not a great price, which is not a price at which oil producers are making a lot of money. And so what has been happening? Well, what has been happening is that production has been shut. People have not been exploring for oil. And then, you add on the thing, which is that generally most Western governments have had the idea that, look, we want fossil fuels to go into decline. So we are going to have, a regulatory sort of like, footprint on it, which makes it very difficult to explore for oil, makes it very difficult to expand, etc. In other words, the oil business has been essentially at like bare minimum in terms of maintaining its current capacity. In other words, we are not prepared. We are not prepared for 1/3 or I don't know, 20% of the world's oil production to go offline. We're just simply not prepared. But yet that may be the price that is required to end the war, to make sure that, other countries don't go and just think like, well, hey, we can go in there and invade another country. So this gets me to the next sort of like set of tabs here, which is that, to prove out that we are at a position with oil where I've been in markets now for like 30 years. I think soon in like, like I'll say close to 35 years. There are, from having been in markets long enough, like you now can have pattern recognition for what is said in and around bottoms, right? And it generally goes like this, which is that at, near, around bottoms, and, the biggest ones, generally have the worst news. In other words, bad news and low prices go together. So, around the bottom, you generally tend to see, headlines that contrast. There's like this dissonance, right? In other words, like media, like if you go and do, just go to Google and you type in oil glut, you'll get like 100 stories. And yet there's these like dissonant notes to this, right? In other words, we can't really account for like something like 4 million of these barrels. There's like, this is one sign, but, one sign is not enough. From my experience, you generally have multiple signs, which is like, oh, look, the layoffs are accelerating. Of course, right? I mean, I told you, like for the last 5-6 years, the oil price simply hasn't been, high enough to be able to sustain, new production or to sustain that entire supply chain. Like, we need oil drillers, we need oil rigs, we need, of course, people that are willing to work there. All of these things, when prices are not high enough, they go into decline. And yet, once again, we see that dissonance. The oil rig count is inching higher. Remember, the headline I just put up, which is layoffs are going on, right? They're accelerating, and yet the oil rig count, in other words, some number of people are like, we're seeing like a supply shortage, and and we're gonna like, rigs are these things that you put into the ground, or you rent them to drag them out in the ocean to drill for oil. The oil rig count is going higher, so that's a dissonant note as well. So here's another one where, the Texas orphaned well count reaches highest level in nearly 2 decades. What's an orphan well? In other words, exactly what it sounds like. It's obviously bad news. In other words, nobody wants these wells. Nobody wants to produce them. They generally happens not just at like some short-term small bottom. These things usually happen at historic, large bottoms from which there is a large jump in price, right? That's my experience. And those of you who have been with me at Banyan Hill remember this is one of the elements of going upness, which is that the news as presented, all seems like all terrible, but yet there are groups of people who seem to somehow ignore the news and are actually walking into danger, increasing their exposure. And that's what we see with the oil rig count. Equally, there's also companies that amidst what supposedly is, terrible, terrible conditions, they're doing fine. Not just doing fine, they're raising cash flow. Eni is one of the biggest oil companies in the world. It's based in Italy. They're doing fine. Again, dissonant notes. These are things that you tend to see at near around bottoms. And here's another example: Shell, which is one of the world's largest companies. Yeah, they beat what would have obviously been pessimistic assumptions, but nonetheless, people would have been expecting their earnings to disappoint. And clearly, they're not worried. They're increasing their buybacks to $3.5 billion. So this again, it doesn't contrast well with what is going on. So the last one I'll put in is super tanker rates are soaring. Now, I mean, one of the reasons for this is, what is going on with the whole, sanctions, financial pressure on Russia thing, which is that if you were buying from Russia before, there's this, black fleet, if you will, of tankers that are willing to go to Russia, etc. Iranian companies are willing to do it. Some Chinese companies are willing to do it. But if you're part of, in some way, shape, or form, part of either the neutral countries or you're in the Western alliance, you don't want to really mess with the US because, they can really put some pain on you. So that is soaring tanker rates, but it is also people who are speculating that some amount of oil is going to go off market, and they are sort of beginning to hoard tanker capacity in anticipation of this. So once again, you don't do that at a bottom where you think the bottom's going to fall out. You do that where you think that there is going to be a price recovery and that the price recovery might last a while because you're buying out capacity maybe for three months or 6 months. So it's another sign, at least to me, that a big oil boom, I'm going to say it, an oil boom is coming. An oil boom is coming. That's what, when I put all this together, that's what, in my judgment, in my opinion, it says an oil boom is coming. All right. Another argument for why this would be an oil boom, not just a short term, hey, the price spikes because, we're trying to resolve the Russia, Ukraine thing, so, in other words, it wouldn't be like the Gulf War, right? That was essentially like a 3-month bull market. I'll say that, we're likely to have a long-term boom 3 years, I'll say on the low side, 5 years, maybe 7 years on the high side. Why? Well, now we come to really, what truthfully I've only most recently come to, which is that it turns out that for the last 20 years, um, the people that we've trusted to give us supposedly objective information essentially have taken a an ideological view of how to make forecasts and make predictions. And they have told us, me, I'll put my hand up, I believe them, that oil consumption was going to go into terminal decline. And so we did not need to explore for oil. And so it turns out now that the International Energy Agency, which is, pretty much run by, the largest governments in the world, is reversing this view. And ENI, which is, the company I mentioned earlier, which does a lot of research, Shell does it too. All the big companies, you can say, well, they have a vested interest in saying so. That may be all true. Nonetheless, they're telling you that there's no real alternative at present to oil and gas. There's just none. And when you throw in, right, the big, the big things going on today, which is what? We need more energy for AI, and we also need more energy to reindustrialize, right? I mean, the world's politicians, policymakers now understand that it was a terrible mistake to hand over the industrial base of the Western world to China, and now they're going to bring it back. That's going to take a lot of energy, right? So you've got short term, you've got intermediate term, and this is, a long term. And this is another story, which is verified, which is that global oil discoveries, which would, I'd say in the 1990s, early 2000s, you'd hear of a big one every 3 years. And we need that to replace all the oil that we are consuming. We just have not been doing it because we have actually believed these forecasts, which turns out, were based on an ideology, which is that we don't want the world to consume more fossil fuels. So we will create a forecast and prediction that says that. And now we are going to see the downside of that. In other words, as prices go up because we did not explore for oil, did not create enough production facilities, in other words, all across the board, whether it be pipelines, whether it be refineries, whether it be rigs, we are short supply, right? This again is this is not going to be a short-term thing. This is going to be a long-term thing because it is going to take years to get everything back. I mean, we already have, in for example, for electricity, to get a natural gas turbine takes 5 years. We don't even know what it would take to, put up a rig today. We've lost the ability to make them. Why? Well, because we didn't want them made. And so whether it be the people with the skills, we've got, metal fabrication. There's so many different things here that we lack. All right. Let me put all of this together, right? What's the bottom line here? Bottom line is that we have short-term, intermediate term, and long-term catalysts for an enormous oil, and I'll say generally an energy boom, right? You want to be long. You want to be long energy in all its forms because it is clear, at least to me, that, this, I'll say, at least 3 years, but that sounds too short. I'll say 5, 7, even 10 years, maybe even longer. This is going to be a battle between the United States, China, and then, neutral countries all taking positions on valuable commodities, right? I know everybody is insane about AI, insane about tech, but this is a backward-looking view, right? The best investments are always looking forward, and they're always asking you to do something that feels like, oh, I don't know, Paul, I've got all these gains in tech. Why would I, hey, I can only present the facts, and everyone has to determine for themselves what they want to do. But we can tell you what we are doing at ATG Digital. We already own or are buying companies that are going to benefit from a combination of the things, that I've shown you, which is that companies that benefit from the potential escalation in a oil shock. In other words, President Trump says, well, you know what, we got to have some pain to have some gain, and we are willing to take 3 months, 6 months of very high prices to end the Russia-Ukraine war. In that scenario, what would go? Well, pretty much, anyone that's got current capacity that can increase capacity, they'll all go up because you can sell more oil at a much higher price. What else good? Well, at a higher price, people are like, well, let's go explore for oil. So, oil rig companies, like which have been in a depression, essentially, like suddenly there's not enough of those, right? So the whole supply chain starts to come alive. Shipping companies, which these are they own these ships, and if you're not, if there's not a lot of oil that is being sent from one place to another, they benefit both from the short term and the intermediate term, because if you take Russian supply offline and you're looking for non-sanctioned barrels, right, you can only buy them from certain places, right? So the ships will all start to go to some parts of the Persian Gulf. Those are all clean, if you will, barrels, and other places that can produce it. So these shipping companies benefit. I mentioned services companies. And then the last one I'll say is strategically positioned oil. So, obviously in the United States, we've got oil, sitting in Texas. We've got, shale oil sitting in various places in the country. But there's also unconventional oil that is sitting in Canada and in other places. And those oil assets, again, benefit from, they'll produce more at much higher price. And so they have fixed costs, right? So any increase in price just drops down to the bottom line as profit. All right. That is Investment Tuesday for today. An oil boom is coming, right? No one wanted it. No one was expecting it. But we did all of the things over the last 15 years to put the conditions underneath for it. And it's coming. Position yourself to benefit. If you are looking for companies that are going to potentially benefit from the coming oil boom, well, check into atgdigital.media. We have, I think, something like maybe 20. We're adding companies. Like on yesterday, we added shipping companies, a couple more oil companies. So if you're a subscriber, check in. If you're not, check into atgdigital.media. Thank you for attending Investment Tuesday. This is Paul saying goodbye.